Hello everybody, and once again welcome to Synanomics, the money machine. Today I'm going to talk about the valuation methodologies for the stocks or the companies. Since we are talking about the stock market and the different stocks the companies have, I'll refer that to stocks and sometimes also talk about the companies, but I believe that you are not buying the stock, you're buying the company, a piece of the company. So in order to understand how much you're paying, what's the real value? So guys, there are two things, right? One is the value, one is the price. Price is what you pay and value is what you get. So price is actually listed in the stock market all the time. But what is the real value? And that's where the crux of the matter is. And that's where the analysts actually use multiple ratios. They can be the profit and loss P&L ratios, or they can be balance sheet ratios. And I'm going to talk about some of those, the most prominent ones today. Well, the first of all to start with will be the PE ratio, the most commonly used ratio, price earning ratio or price to earning ratio. As the name applies, guys, the name implies price you are paying for the stock or a share, and the share, what's the share is earning for you. Okay, I'll take one step back. So when you look at a company, the company actually has a profit. Suppose the profit is X billion dollar. If you divide that by the total number of shares issued, that will give you earning per share. We also call that EPS, earning per share. And when we are talking about price to earning, we are talking about the price you are paying for one share versus earning per share. And that's actually going to give you the PE ratio, guys. And from the analysis perspective, all of them actually look at that. For an example, if I'm not wrong, S&P 500 for that matter, right now is trading at around 18-19 PE ratio. Then you can compare also that if you're buying a company which is trading at say 28, say Apple for that matter, Apple is trading at $28, Microsoft is trading at $36. So as compared to S&P 500, these shares are expensive. Having said that, that's not an apple to apple comparison, guys, because you are comparing 500 shares of multiple segments with the IT stock, with the Magnificent Seven. So what will be the real apple to apple comparison? You can compare within the Magnificent Seven, something like that. Or if you are talking about one particular company operating in a certain segment, for that matter, say Apple or Microsoft, you will have to compare that with the IT. If you are looking for some other company for that matter, say Costco, then you have to compare that with Walmart and others. So you have to be in the same segment to have a more clearer and rational comparison. Well, when we come to price to earning ratio, again, I think this is just tells you the price you are paying as compared to the earning potential of that share. Technically, the lower it is, the better it should be, because that means the company is undervalued, the share is undervalued, and that means there is a potential that the price will go up further. There will be a PE expansion. In that context, if suppose all the peers in that segment is trading at around 30 and you are picking a company which is trading at 20 or 22 for that matter, that means sooner or later it will expand, the P will expand to 30, and what will happen if P expands? Of course the earning will expand as well, but the price will go up further and more rapidly. So P expansion means the price will go up. Well, sometimes it's very, very difficult to actually understand that what should be the right PE of even the market for that matter. If S&P is trading at around 20, what should be the value? What should be the right PE? And there is a rule of thumb. It's not really scientific, but it's a rule of thumb that you divide 100 by the interest rate and that will give you the price earning ratio of the index of the company or the country in that matter. For an example, in USA, say the interest rate is around 5%. So divide 100 by 5 and 20, that gives you the price earning ratio for the index, which is more realistic or rational, and that's pretty much aligned with the S&P 500, guys. So that's the rule of thumb. Please don't take that as a scientific method. Well, a company's earning is either based on the historical earnings or the forward earnings. So when we calculate the price earning ratio, there are two ways to do that. One is the price earning ratio historical for the last 1 year, what was the earnings, and at the same time, which is more popular, is that the forward looking. So P for the forward earnings. So for an example, what will be the forward earning for 2025? And then you divide the current price with the forward earning. That will give you the price earning ratio with the forward earning. And that's commonly used for most of them. The second very important ratio is called PB ratio, price to book ratio. And the book value of the company is actually the net asset of the company, and that you can actually say the total asset minus the total liabilities. In simple terms, if the company has to close down today, what will be the value one will get? So it's very simple. Whatever are the assets, you take away all the liabilities, the debts and everything out of that, and whatever left is the book value. And then you take the complete total book value, divide that by the number of shares, and that will give you the book value per share. And when you talk about the price to book ratio, we are actually talking about the price it's listed at divided by the book value per share. Price to book value is a more robust ratio than price earning ratio. Needless to say, price earning ratio is pretty much P&L focused, whereas price to book, because we are talking about the net asset minus liabilities, are actually a balance sheet ratio. Lower the price to book value is, higher the potential for the price to go up, because that means it is undervalued. So suppose a company has price to book value of 1. That means it's a value investor's delight, guys. That means even if the company, if you are paying $100 for that share, even if the company closes down today, the net value will be $100. So not going to lose anything. The higher the price to book value is, overpriced the share or the stock is. Well, the third one is even more interesting and commonly used actually. Enterprise, it's also called enterprise multiple. It's called EV to EBITDA. EV is the enterprise value, and EBITDA, we all know that, earning before income tax, amortization and depreciation. So EV, which is the enterprise value, is basically the value of the company if you want to overtake it. Suppose you want to buy one company, and you have to actually find out what's the market capitalization of that company, because you'll have to pay that to the shareholders. And then you'll also have to pay for all the debts the company has. And what's going to help you in that? The cash and the cash equivalents. So if I have to put that in a formula, so EV, enterprise value of a company, is actually equal to the total market capitalization plus the debt, total debt, minus the cash and the cash equivalents. That's what you will need to overtake a company. And that's what's called enterprise value. So in the enterprise value, if divide that by EBITDA, EBITDA is again earnings before interest, tax, depreciation and amortization. If you divide that EV to EBITDA, that will give you a ratio which actually tells you that if you overtake the company, if you buy the company, how long it will take for the company to pay it off to you. Suppose you have purchased a company in $100 million and EV to EBITDA ratio is coming at around 20. That means in 5 years' time, you will actually pay it off. I'll kind of paraphrase that again. Suppose the enterprise value of the company is 100 million and the company generates the EBITDA of $20 billion every year. So when we divide that 100 to 20, that's 5. That means in 5 years' time, whatever you are paying today, $100 million, you will be able to recover that. And that's how it is. This is a very, very powerful ratio to determine the value of the company, guys. The higher the enterprise multiples are expected, the higher enterprise multiple, I'm using the enterprise multiple for EV to EBITDA ratio. So higher enterprise multiples are expected in the high growth companies and lower enterprise multiple is expected for the slow growth companies. It's very simple, because as the company will grow, the profit will grow as well, and that means it will actually give you much faster return in order to recover whatever you have paid for that company. If the company is going very slow, that will take a longer time. So it's pretty normal. Another one which is also very important is that, because as I talked about in the EV as well, in the enterprise value, that debt is a very important component of any company's operations. So another great ratio or the important ratio is debt to equity ratio. As the name applies, is the total liabilities or the debt divided by the shareholders' equity. This actually tells you that how much debt the company has taken. So if the company net equity is just 100 million for that matter, and they have taken a debt of 200 million, that means the debt to equity is 2. That means the company has taken too much of debt. So debt to equity ratio actually helps the investor to determine how a company finances its assets. Before you purchase any company, you need to actually see the debt to equity ratio. Having said that, as I mentioned earlier, you have to compare apple to apple. So you cannot compare a bank or a financial company with, for that matter, an FMCG company, fast moving consumer goods company. For an example, you cannot actually compare a bank with Nestle. You cannot compare IT company with infrastructure company, because their structure is totally different from the debt perspective. So you have to look at what is the debt to equity ratio in that segment, and then you have to decide that way. Having said that, debt, especially in the higher interest rate market, higher interest rate environment, is really not something everybody will be happy with. So the companies with the debt to equity ratio much lower, say less than 1 or less than 0.5, is considered very healthy from the financial perspective. Now the other important ones are pretty much in the balance sheet is the free cash flow. We all know that the cash flow statements and all those, right? So the three things are very important: P&L, profit and loss statement, balance sheet, and the cash flow. Free cash flow is a very important parameter to judge the company's financial positions and the valuation. But what is free cash flow? Free cash flow is basically the cash flow from operations minus capital expenditure. Every company actually spends money to purchase machinery or the other fixed assets for that matter. They have to expand and buy some offices, or they have to buy the machinery, and all those things. So they will actually invest there, and that's what the capex are, capital expenditure. And that capital expenditure is actually done through the cash flow from operations. So if you take that out from the cash flow from operation, whatever is left is the free cash flow. So free cash flow is really, really important for a company to show its valuation. Free cash flow, or the FCF as it's also called, is, as I mentioned just now, is the cash left over after the company pays for all its operating expenses and the capital expenditure. Free cash flow shows how efficient a company is at generating the cash, and therefore it's a very important metrics in determining whether the company has sufficient cash after funding all its operations and the capex, etc. So that's really important for you to understand. When a company's share price is low and the free cash flow is on the rise, what does it mean? The odds are good that the earnings will be increasing actually, and the share price will soon be heading up. I'll repeat that. When the company's share price is low and the free cash flow is on the rise, increasing, that means sooner or later the price will catch up. That company is pretty much like a cash generating machine, guys. Another one there is basically, before I move on, I should also say that in the price earning ratio, as I was talking about, that there is some confusion out there that how will you say that the PE ratio should be 20 or 30 or 40. Similarly, the example you just saw that, right? Now with the forward earning, the NVIDIA, the price earning ratio is around 25. I just talked about Microsoft is 36, Apple is 28. So all these companies in the Magnificent Seven itself have multiple price earning ratios. But how will you understand and determine that what is the right price? Of course, you can't determine in absolute terms. You have to take in more relative in relative terms. But still, little bit of a challenge is there, and that's why I have talked about the other rule of thumb as well. 100 divided by the interest rate. That actually gives the rough price earning ratio an index should have, or a country should have. Well, many analysts actually give more importance to price PEG ratio, price to earnings growth. They say if the company is actually just earning, say, $20 every year and the price is 100, that means the price earning ratio is 5. So the earnings may not grow, but the price can grow, and that means the stock can become overvalued over time. That's why the another ratio, very, very popular one, very common one, is PEG ratio, price to earnings growth, guys. As the name applies, instead of earnings there, we are taking the earnings growth here. So the PE ratio, I'll repeat that, the PE ratio doesn't allow, it doesn't always tell us that whether the ratio you are getting is appropriate for the company's forecasted growth rate. With the PE ratio, you cannot determine the growth rate of the company. If the PE ratio is 18, how does it matter whether the company will grow or not? We don't know. The company can continuously give the growth can be 0, means the company is actually giving you $20 billion, and the market is like, the market cap is $100 billion. Or in shareholders term, if you are paying the price of $100 for an earning per share of $20, that means it will always be 5, and that $20 can be $20 for next 10 years. So the price earning ratio doesn't tell you whether the earnings is going to grow or not, and that's why PEG ratio is very, very useful in that matter. It actually tells you what is the price today and what is the expected growth rate in earnings. Typically, a stock with a PEG ratio of less than 1 is considered undervalued, and there is a potential that the price will go up in future. If it's more than 1, it's still considered overvalued, because the price you are paying is much higher than the earnings growth. So you should actually see both PE ratio and PEG ratio together. That will give you a complete holistic picture that what is the PE ratio right now, how it is, whether it's a cheap or expensive as compared to its peers, as compared to the index, and at the same time PEG ratio will give you the earnings, future earnings potential for the share or for the company. With that, actually I'll go to the two other important indices or two other important ratios actually. One is the return on equity. So what is the return on equity? So you can actually see that the earnings before income tax, I mean EBITDA for that matter, earnings before interest, tax, depreciation divided by the equity, that will actually give you the return on equity. That's an important one. Basically just tells you that how the company is using its equity to drive the profit. That's considered a very important ratio as well. There's another one related to that is ROCE, earnings, return on ROCE, return on capital employed. And what is the capital employed? Is basically the total asset minus the current liabilities or the total shareholder equity plus the debt. So in any company for that matter, let me explain that in layman's term. In order to run a company, you will need some equity, some capital of your own, liquid cash, and you'll take some loan from the bank or from somewhere. So you'll have the total capital is made up of debt and equity. So when we are talking about the return on capital employed, ROCE, then we are essentially talking about earnings before interest and tax, EBIT, divided by the capital employed. Remember guys, here is we are not using the depreciation there, not using the EBITDA, we are using the EBIT, earning before income tax and interest, divided by the total capital employed. And what is total capital? The debt plus the equity. So it's very similar to the return to equity, return on equity ROE ratio. And this is a little bit additional to that because it also takes into account the debt perspective, the debt part of it. Because there may be a situation or the type of the company, for banking is a classic example. You cannot run a bank without taking a debt. So you will actually raise the capital in order to finance it. So in the banking kind of situation, ROC is a much better indicator than the ROE. Whereas the companies who don't need debt, for that matter, who are debt-free companies, ROC will be exactly similar to ROE. So there is no point of calculating ROCE. So ROC is more important where debt is important for the company to run the operations. The higher the ROCE ratio, the more efficiently the company is making use of the available capital to generate profits. Just like in the ROE, the higher the ROE is, the more efficiently the company is actually generating cash or generating profit by using its equity. Well, last but not the least, there is another important ratio, it's called ROA. Just like ROE, return on equity, return on ROC, return on capital employed, we also see return of asset. And that actually gives how efficiently the company is using or utilizing its assets to generate profit. Just like ROE and ROCE, ROA, return on asset, is equal to the net income divided by the total asset. Well, the high value of ROA actually shows the strong indication that the company is actually functioning well and making significant returns from the current assets. As with the other profitability ratios, the ROA is best used for companies to compare similar company in the similar industry size. Well, I'll repeat that again. As compared to the others, ROA is also used to compare similar companies in the same industry. You cannot compare ROA, or for that matter ROE or ROC of IT company with an infrastructure company. You cannot compare that with a the fast moving consumer goods company, for an example, like supermarkets like Costco or Walmart. You can't compare that with Apple. You have to compare within that segment. Well, let me paraphrase that, and let me actually summarize that. We have covered today the different methods of valuation, how you'll value the company, whether the price you are paying for that stock is good or bad or ugly. Are you paying too much? And the ratios that we have talked and compared is price earning ratio. And the same time I talked about it, PEG ratio, price to earnings growth ratio, price to book ratio, EV to EBITDA. And then we talked about return on equity, return on capital employed, return on asset. So there are multiple of these which actually gives you the different ratios to compare. And if you look at some of the debt side of that, debt to equity we talked about the two important balance sheet methods as well, the free cash flow. So all these actually are very important from the fundamental analysis of the stock. There's another way to value the company, and that's called technical analysis. That is just to do the analysis by seeing the price fluctuation, irrespective of what the company is, what the underlying share is. If somebody has given you a price fluctuation of this, based on that, by using different methodologies, you can actually analyze and see what will be the future price action. I will talk about that in a different video. Today, it was more about fundamental analysis of a stock or a company. Well guys, if you like this kind of content, don't forget to like, share and subscribe. All the examples I've given to illustrate the different ratios were for education purposes. So before making any investment decisions, please don't forget to consult your financial advisor. Synonomics is out there to create financial awareness so that you can understand the investments you are making, analyze the companies you are interested in before you buy and make money. With that, I'll come back again with another interesting topic. Till then, it's goodbye from your finance coach, Pankaj Sinha. Bye-bye.